Traders War Room proudly presents the daily video with the best trading and investing alerts anywhere on any platform. With up-to-date stock, chart, and market news, TWR is simply your one-stop shop. TWR Tech Video. Activate your 2-day trial of TWR All Access on the Discord platform. Stay tuned at the end for TWR Hot Products and Services. Tonight's tech video is going to be on market breadth. What is this? What does this tell us? And how can we use this to ultimately make money? So what is market breadth? Well, put simply, market breadth indicates and analyzes the number of stocks advancing relative to those that are declining in a given index or on a stock exchange, such as the NYSE or the NASDAQ. Positive market breadth occurs when more stocks are advancing than declining. This suggests that the bulls are in control of the market's momentum and helps confirm a price rise in the index. Conversely, a disproportional number of declining securities is used to confirm bearish momentum and a downside movement in the stock index. And certain breadth indicators also incorporate volume. And it's a little more deeper than that too, because they won't just look at whether a stock is advancing or declining in price, but also at the volume of those moves associated with the advancing and declining. This is because price moves on larger volumes are considered to be more significant than price moves on lower volume. Those of you that follow analysts probably have seen an alert like this: SPY or AMD volume spike, and then you go in at a certain price target for an expected move either up or down. This can be both bullish and bearish. Understanding market breadth, we need to get that it refers to how many stocks are participating in a given move in an index or on a stock exchange. For example, an index may be rising, yet more than half the stocks in the index are falling. But because a small number of stocks have such large gains, they are dragging the whole index higher. Market breadth indicators can reveal this and warn traders that most of the stocks are not actually performing well, even though the rising index make it look like most stocks are doing well. An index is an average of the stocks in it. And we know this to be true because when we look at SPY, we know that when we see moves like this in SPY, typically what are moving the SPY to make that push? Well, the Apples, the NVDA, Microsoft, Netflix, Tesla, etc. When we know that the S&P covers 500 stocks, but those are the ones that are making the impact and causing the broader market to run. Now, volume is also an important indicator, and it may also be added for calculations to provide additional insight into how stocks within an index are acting overall. Market breadth attempts to find how much underlying strength or weakness there is in a given index. By assessing the strengths and weaknesses, which isn't plainly visible by looking at a chart alone on the index, technical traders gain the insight into what the index may do next. A large number of advancing stocks in a sign of bullish market sentiment and is used to confirm broad market uptrend. A large number of declining stocks show sentiment is bearish, which would align with an index downtrend. When measuring market breadth, many indicators look at the number of advancing and declining stocks or the number of stocks that have created a recent 52-week high or low. This data can provide information about whether an index uptrend or downtrend is likely to continue. Now, when you're talking about market breadth indicators and their uses, there are a number of market breadth indicators. Each is calculated differently and therefore may provide slightly different information. Some indicators look for the number of advancing or declining stocks, others compare stock prices to another benchmark, and a few incorporate volume. The tactic for most market breadth indicators is to monitor for confirmation and divergence. Confirmation comes from when the indicator is moving favorably and the index is rising. Divergence is when the index and indicator move in opposite directions. Now, this divergence warns that the index may see a reversal soon. Here is the most popular and arguably the most accurate market breadth indicators available with a description of each one. Advance and Decline Index. This indicator, also known as the AD line, calculates a running total of the difference between the number of advancing and declining stocks. Traders typically look for divergence between the indicator and a major market index, such as the S&P. For example, if the S&P 500 is rising and the AD index is falling, it indicates the current uptrend in the index may be losing its momentum. On the other hand, if the S&P is falling and the AD line is rising, it suggests that the move lower in the index may be about to reverse. Another popular indicator is the New High-Low Index. The New High-Low indicator compares stocks making 52-week highs to stocks making 52-week lows, and a reading below 50 indicates that more stocks are reaching their lows compared to stocks that are reaching new highs and could signal a move into a bear market. Contrarian investors may use the market breadth indicator to buy and sell stocks when it gives extreme readings such as below 30% or 70%. And I'm sorry, I meant to say above 70%, similar to the RSI. Now, this one is interesting because this is what is considered almost a benchmark, specifically in a major index, the S&P 200-day index. Traders can use this index to see what percentage of stocks in the S&P are trading above their 200-day moving average. A rising indicator above 50% indicates broad market strength. Similar to the new highs, new lows, traders often look for extreme readings to find overbought and oversold conditions in the broader market. Short-term traders who want a more sensitive moving average to provide earlier signals can use a 50-day index that shows what percentage of stocks are trading above their 50-day moving average. Now, this one is very important because this one acts as a benchmark for longer-term investors or those that are looking for the dramatic shift of continuation or reversal. Cumulative Volume Index, and this indicator measures volume. Stocks that rise have their volume added to positive volume. Stocks that decline have negative volume, and the indicator keeps a running total of whether the overall market is positive or negative and by how much, and is used in a similar fashion as the AD line. Now we have the on-balance volume, or OBV, and this indicator also looks at volume, except up or down volume is based on whether the index rises or falls. If the index falls, the total volume is counted as negative. If the index rises, the total volume is positive. I'm sorry, that was a typo right there. That negative is supposed to be positive. Each day is added or subtracted from prior readings to give a running total. It is used in a similar fashion as the AD line and some of the other indicators that we've gone over. So let's go over an example of market breadth analysis in action. The following chart shows the S&P along on the OBV indicator and a cumulative volume index for all U.S. stocks. During the rise in the S&P on the left, the cumulative volume index confirmed a rise as the indicator continued to make higher highs along with the S&P 500. The OBV had a different story as the indicator was mostly flat, issuing a warning sign that there was some underlying weakness in the rise. This was followed by a steep price decline. Then, when the S&P rebounded, so did the market breadth indicators, as you can see on the chart. This chart is kind of small, so I'll blow it up so you can see it a little bit. And as you can see, the different ones, one is going with the stock and the other one is showing that divergence. Now, what is meant by market breadth? Well, as we talked about already, the market breadth looks at the breadth of the market as a whole. It seeks to determine the strength of moves in an index, generally by examining the number of stocks that are rising relative to those that are falling. And you can see a chart like this shows different sectors and different indexes as they run relative to each other. Now, what's the difference between market breadth and market depth? Well, the breadth studies the strength and weakness of moves in a major index. Depth, on the other hand, is a market's ability to handle relatively large orders without significantly impacting the price of the security. And I blew this one up because I wanted you to be able to see this and how it correlates to the S&P. Excuse me. In yellow on the top, you can see where the S&P is highlighted with the difference of the sell and the buy signals. And then on the breadth chart, you can see where it's relating in the yellow. And then the depth chart on the bottom is where it's relating to the sell signal and the buy signal on the S&P. So the question that you get all the time is this a good indicator? Well, market's breadth indicators derive their information from price and volume. They judge market sentiment. But like all indicators, it's always best to confirm information with price. A good rule of thumb is to never base trading decisions on what the indicator is saying, always confirm with price. But yes, utilizing breadth in correlation, or conjunction of other indicators is always good because this gives you great confirmation whether a trend is present, continuing, or looking to possibly reverse. All right, so in conclusion, when investors use the phrase market breadth, they're talking about a set of technical indicators that evaluate price movements in a given stock index. Sometimes an index may rise even though half of the constituents are falling, and market breadth indicators will let us know if this is the case. A good market is there to determine the strength or weakness of the major index. Now, this information should be used to confirm with price action, all right? So you want as many indicators as you can have to not clutter, but to give you confirmation. So indicators that follow along with the current strategy being used. When more stocks are advancing than declining, it suggests the bulls are in control. Conversely, when more securities in the index are falling, it suggests that bears are in control. And because market trend, they go rising and falling, momentum may indicate rising or falling price trends as well. And all we're trying to do at TWR is just provide more ammo for your weapon. The stock market is our war zone and trading are our battles. When you look at it in that way and you set your mindset so that you're prepared to literally attack, conquer, and destroy, we need to understand that losses happen in this game that we've chosen, okay? Battle damage occurs. We take that, okay? But failure and retreat are never options, and if you are prepared, disciplined, and you stay consistent to select rules and always refine your strategy, you will make it in the end and you'll be successful. As always, that's all I got for you guys. I'm Chuck Fu with Traders War Room, and if you're ready, follow me and let's go to war together, team. Upcoming events. Our next class is set. I just don't have it on the website yet. So expect to see this on the website either Monday or Tuesday for purchase, but we are going to teach you how to navigate and trade futures. We have a guest instructor, Expo Jesse, who's a very popular futures trader out there. I mean, he's on a whole bunch of servers, and we got him going to teach this class. This is going to be a different class. Normally do them on weekends, but we're going to do this class on a Wednesday evening so that you can utilize the teachings and you can go attack the market Thursday and Friday and kind of get some good information and go out there and attack the future market. So we'll see how this one rolls, but $15 gets you a seat. And as always, every purchase keeps the recording. So I hope to see you guys there. And again, this will be on the website either Monday or Tuesday and ready for purchase. I want to invite you all to come try one of TWR's one-on-one mentoring. Listen, if you're struggling out there, if you're looking to refine your skill, I want to invite everybody to try one of our TWR one-on-one mentoring sessions. Listen, if you're looking to develop skills, gain confidence, receive guidance, refine strategies, get a pro perspective, or just basically explore new plans of attack, come check us out and book yourself a one-on-one session. Okay, usually they run between 30 minutes to an hour, depending on what session you get. You get to keep the recording, and we can do a deep dive into you as a trader and investor. So if you're interested in booking a session and you'd like to take me up on this, go to this link here, traderswarroom.com/mentoring, and the link, of course, is in the description. So all you got to do is click on the description, go to the hyperlink, go there to the website, read our bios, and pick your analyst. And then, of course, we'll execute the session. Activate your 2-day trial of TWR All Access on the Discord platform. We cover it all at Traders War Room, whether you're looking for stocks, options, futures, Forex, crypto, or even sports betting, or you want real-time alerts, live trading, algo signals, or even if you just want to be part of a community of like-minded investors to grow, learn, and share together as a team. Something for everyone at Traders War Room. Activate your 2-day trial today and go to war with TWR. The market is our war zone and stocks are the battle. Join TWR and let's go to war. Make the market bend the knee in 2023. Join Traders War Room and bow to no one. Let's go to war.